the candor is really the service. But if the money isn't compounding, you failed at your actual job and the relationship doesn't pay for anyone's retirement. So service in the absence of returns is hospitality. And we're here to manage capital and manage outcomes for our clients.
Hello and welcome to this special episode of WPTV. My name is David Katai, Senior Editor at Wealth Professional. In the wake of our 2026 Wealth Professional Awards, WP is highlighting a few of our excellence awardees, showcasing the insights and approaches that earned them their place at the award show. Today, we have one of the excellence awardees for the Centurion Asset Management Award for Advisor of the Year, Alternative Investments, Chad Larson, Partner and Senior Portfolio Manager at MLD Wealth. Chad, welcome to WPTV.
Thanks, David. It's great to be here, and congratulations to everyone that WP recognizes here. It's been a great room to be in.
Well, special congratulations to you for this excellence awardee and some of your other victories on the night. But let's start with this category in particular. Why do you think you were named an excellence awardee in this category?
I think it's because we actually manage alternatives. We don't just sell them. And that's a real difference. A lot of this category is product distribution. Here's a private fund, here's an idea, here's a structured note, sign on the line. And we treat alternatives as an active discipline matched to clients' real liquidity needs, really driven by a macro view and rebalanced as that view shifts. And I think maybe the rarer part is the straddle. I came up as a retail advisor and crossed into running money like an institution. And most people only ever live on one side of that line. Bringing the institutional toolkit to private clients and actually piloting it rather than parking it. And I think that's what really got noticed and is noticed by our clients. So the award's a byproduct of doing that work properly year after year, not the goal.
Mm-hmm. So I think you've already hinted at this, but let's get a sense of your practice overall. What exactly do you provide to clients?
Sure. So I run a multifamily office here at in partnership with Canaccord Genuity. And I think the simplest way I describe it is, on the money side of things. Now we do everything full cycle, from estate planning, taxation, insurance, and retirement income planning. But on the money side, I say the simplest way is that we run money like an outsourced CIO. We're not a stock picking shop chasing tickers. We manage the whole allocation the way an institution would. So I manage about $1.7 billion across the MLD platform for private clients, families, and business owners, and also manage a prospectus cleared fund externally at the firm as well. So what clients actually get is two things. One, it's an institutional toolkit, real assets, private markets, alternative, packaged for people who'd normally never get access to it. So I spent a career straddling those two worlds, the retail advisor's relationship and the institutional manager's toolbox. And most people only get one or the other, and we give them both. And two is they get honesty about risk. We'll tell you, when we're being patient and when we're carrying cash, and when we don't love the price. The candor is really the service.
Mm-hmm, mm-hmm. Let's go a little deeper on that asset allocation side of things. What is your overall approach to asset allocation? And then how do you weave, your private asset allocations into what you're giving to your clients overall?
Yeah, listen, I think if there was a perfect algorithm or a slide or, Google or someone would have solved for it right now and everyone would figure this all out. But the honest framing is that in alternatives, most of the time you're capturing two things: an illiquidity premium and a complexity premium. And you get paid for tying capital up and for doing work that most people won't do or can't do, which means the most important question isn't what's the return. It's what are your clients' actual liquidity needs? Match the lockup to the life. Get that wrong, and the premium that you're trying to capture really becomes a trap. And I push back, I think largely from tailwinds or headwinds that some of the parts of the sector are getting, in alternatives in general and credit especially, that there's some structural problem with it. And the headwind isn't really structural. It's the structure, kind of a wave of easy money and poorly allocated capital chase the theme and pour it into badly designed funds. People buying with the rearview mirror. And that's not the asset class failing. That's bad construction failing. We do it differently. We allocate off a macro view, and when the macro shifts, we react and tactically rebalance. You don't just collect a pile of alternative investments or funds and call it diversification. that's a closet, not a portfolio.
hmm It's funny, I think you've already kind of addressed this question implied, but it's interesting talking about alts this year when public markets and public assets generally have done so well. So how do you kind of balance the client FOMO around why am I in this when the S&P is ripping?
So it's great, kind of and tangentially is that parts of the market, are ripping. And I think if you were in the hyperscalers, if you caught gold right, I think a lot of it thematically, sure, indices have been driven higher, but there's just small GIC sectors that have really been doing a lot of the heavy lifting. So indexing has worked largely in line with clients' goals and expectations. But you're kind of just sitting in the hot tub expecting that your, lower back doesn't hurt as much. And that's generally worked for now. But some real cracks in the armor is you're starting to see, obviously, like the software trade started coming apart. But we really start by building a defensible core. And I think that's where a lot of people get things wrong is they've looked to alternatives, to do the magic, or the satellite exposures to do the magic, because largely and generally what we've seen in a balanced 60-40 world, or where a lot of the general capital ends up, where people have a lot of their exposure, has been fair to middling average results. So start by building a defensible core, and then satellite, you can actually have conviction, but sizing it honestly. And I think the contribution from those high conviction positions can be real. But so is the risk. So with respect to the FOMO trade is that that's not all we do as alternatives. We do have a core business, and 80% of what we do, I always said, is within the fairway of earning our fair share of public market returns. So it's not a case where FOMO is creeping into the client discussions because we're, hitting singles in our alternatives and I'm having to defend, well, look at our correlation, look at our low volatility, look at all of these things that, they're not paying you now, but they might. I haven't had to have those conversations because we're performing on both sides, of the coin. So, the rule I kind of hold you is that, you fund additional, risk, out of surplus gains, not out of a need to make up lost ground. So when we have strong moves within the marketplace, we're capturing, those profits. So the moment you start sizing up to claw back a loss, you've stopped investing and really started gambling. So you got to really make sure that the core is doing its job and let the wins accumulate and take bigger swings with house money and never with the rent, if that makes sense. So conviction earns you the right to size things up. It doesn't entitle you to ignore downside.
I don't know if you ever played rugby. There's
I did, yeah.
So there's the line that every rugby commentator says, which is, you have to earn the right to play wide. You have your forwards, your big bruisers who are doing the damage and winning the ball for you. And then you've got your fast guys out on the wings. And once the forwards have done their work, those guys can take over. And it seems like there's maybe a bit of a rugby team metaphor to be applied in your approach.
Well, it's a team. You hit it. You can't just, I think Canadians in general have accepted average across the board. With respect to their core capital, and just say, well, that just is what it is. I'm supposed to get these, mid single digit like returns in my 60-40, and that's where I'm supposed to put most of my money because that's what mom and dad taught me to do. And then I'll playing around the edges, expecting that these more exotic parts of the portfolio are going to help me. And I think that's just the wrong way. Like, it takes a team, but everyone, the winger's never going to get the ball, unless the big guys do their job too. So the whole team has to work to win.
Mm-hmm. So talk to me about the MLD Core Fund, which is that fund that you manage. Your first answer was about how you manage alternatives. Talk to me about the MLD Core Fund and what it is and the role that it can play specifically in a portfolio.
Sure. So the MLD Core Fund, I launched over 8 years ago. Now it's a prospectus cleared fund, liquid daily. It's got a 60-40 mandate. Like, it's about as vanilla as it gets. So, it's outside of, what the reason we're talking with respect to allocating to alternatives, but it's thematic and topical about how we're able to size things appropriately. So it's prospectus. It's a tactical balance fund, fully liquid multi-asset. I launched that when I joined the firm, and it wasn't a catch-all way, but it was the simplest way for me to express, my views of capital markets. I think, in real estate, it's location, location, location. When it comes to investing, I believe it's allocation, allocation, allocation. And I think 80% of the decision, or the result is is done before you get down to start picking the things. I think, I tried to make some analogies around like racing a car. Was you got to size the car up for the terrain that you're in. Ferrari's a phenomenal vehicle, but if you've got to go do some off-roading, it's the wrong choice. So allocating across economic cycles into different geography styles, currencies. So, it is a tactical fund. It can hold cash when cash is the right call. It can rotate globally. It can own gold. It can hold real assets. Anything that trades, within what a prospectus cleared fund in a 60-40 landscape, is what I do. And it's all large up cap and largely, it's the ballast of portfolio. So it is pinned to a 60-40, but has the ability within the prospectus to tilt up to 70-30. So it has to ride whatever the index gives it. But the role that it plays is it's a true anchor holding the disciplined all-weather center of our portfolios, which are built to navigate regime changes rather than participate in the last one. So, and the record really backs it up. Listen, it is the number one fund in Canada over a 1, 2, and 3 year period, not just first quartile, but the number one ranked fund out of over 300 mutual funds in the country, within its segment. That was as of May 31st, as per fund data. So it's the proof of a concept for everything that I say about allocation. When allocation is the engine, a vehicle that can actually move the allocation is really where the edge shows up.
So, and I think you laid it out in some ways in describing the fund itself, but what drove that outperformance? What is going on within this fund that really caused it to be that top performing fund in Canada?
So I answered this in a different interview or in a podcast recently, and I don't want to oversimplify it and make this sound, like that the fund is managed like a hedge fund. Like this is, I want to say it's as boring as it gets. There's, T-bills are much more boring, but what's driven it isn't a single hot call. It's a process repeated through some generally hard tape, tariff shocks, rate hikes, a pandemic. The same discipline held through all of it. Allocate first, respect the price you pay, carry dry powder when the math doesn't justify being fully deployed, and own real things with scarcity value as the anchor. You don't sit at number one over 3 years and first quartile over 7 by getting lucky. It's a philosophy that's executed consistently in good markets and ugly ones. So listen, that's a bit of a banner and a good tagline to say, but people want to know how I did it. I think, I'm an economist by background. So what really drove a lot of the attribution last year was precious metals. Was I'm not down in the weeds finding a good mine in Sri Lanka or some obscure part of the world. When we saw M2 and money supply growing, the economist told me that, central banks would be forced to acquire more bullion, to keep the ratio of bullion to foreign reserves at a certain level. Like to me, that I always said I've had a great career out of having a very strong IQ, and it's not intelligence quotient, it's implementation quotient. It's if money supply is going up, we generally know that gold prices will track those, much like when interest rates go up, bonds go down. So it's actually having the conviction, and I guess doing my job that I'm supposed to do as a capital allocator and as a money manager. So precious metals did a lot of the heavy lifting. But when we started seeing, interest rates were high, we were carrying a lot of cash, we were getting paid very well for it from a risk-free rate perspective. Bullion was cheap. We started picking away at bullion. When the bullion trade started to happen, we said, okay, we want to own some large caps because they're selling a product with a higher commodity, which will translate into higher earnings. So, how do I allocate with, almost $2 billion? I can't go get smart on a gold name real fast, but I can allocate to a sector through an ETF. So we would build a position in large cap gold producers. As that trade really started to take off, we realized that these companies would become very much bloated in cash in their balance sheets. So they would start to return capital through enhanced dividends or share buybacks, and that would continue to feed itself. But eventually they would have to deploy capital, and we'd enter an M&A cycle. So all along, I'm selling the top part of the trade to fund the next leg of it. So as the Boolean trade got bloated, we would take those profits and buy the large cap trade. And as that trade, really the attribution was there, and we would kind of come down market cap. And now I'm in a really unique place. Like the fund's over 20% cash right now. And I'm convicted in a new thesis of not owning beta, but just sticking with alpha, is that this market feels a little spongy. It feels, albeit the earnings are real, it's not this hollow market that everyone's worried about. The AI trade, the CapEx build out is translating into real economic activity. But with valuations being of concern, I'm saying if every day we have VAR, value at risk, and capital at risk, we want to make sure that we're there. But if I can deal with as little as capital as possible because I'm nervous or uncertain, my attribution and leverage can come from convicted alpha, where I don't have to have as much capital deployed.
That makes a lot of sense. And I mean, it's again brings us maybe back to that alts conversation that we started with. So maybe talk to me about your view of where the role alts play, and almost the utility of alts when they're paired with an outperforming, but as you say, kind of, I mean, it's in the name, a core fund like core.
Well, it's the same. It's like they do different jobs. And one of the things that we've seen, where we would have all studied investing, like when we were kids, is that, your fixed income was supposed to be your goalie and your offense was supposed to be your equities. And you would play with a balance, whether it's a 60-40, a 70-30, an 80-20. I've seen it all, like rules of your age should match your, fixed income weighting. So the older you get, the more fixed income. Like, again, if there was a right way to do this, it would have been solved and stamped and made into some law. But when I look at the intercorrelation or the correlation between asset classes during periods of like market dislocation and shock, like it feels like markets they go up like escalators and down like elevators, but seemingly the correlation between even fixed income and equities is almost 1-to-1 now. It's like when it's all not working, it's all not working. And so I think the alternatives in themselves, and yes, in the short term, people and pundits would argue that the lack of volatility is just a mismatch, a gap between price smoothing and non-discovery of valuations, and that it's all kind of a ruse in that. But again, I would say the core is that liquid all-weather engine, and it's how we express the macro allocation, and clients can move in and out of it. And private assets, or when we add things you simply can't get. And this is that hard asset exposure, these contractual incomes and returns that aren't just writing public market price momentum. One of the best ways that I can explain like an alternative, where so many of these things, they almost try, like Bay Street, Wall Street does a great job of trying to create a liquid proxy, to attract capital, whether it's, a private credit like adjacent fund or an ETF, buying some of these BDCs. You're trying to make adjacency to capture fund flow. But when I look at like infrastructure exposure, I say, okay, if I'm going to go, and I won't pick on any one name, but if I'm going to buy an infrastructure stock, a pipeline company in the public markets, I'm paying between the bid and the ask of what the market's willing to bear for that. And it's going to be a function of, price to cash flow, price to earnings, or some metric, some multiple of that. So when we look at infrastructure at the private level, we are buying that physical asset. Yes, we're also paying a function of its, we're going to make a valuation thesis of where it moves into it. But the mark on that on a day-to-day basis isn't a function of people being fearful or greedy. It can't trade up, and I can't take a mark because, everyone's piling out of, like, the market goes into contagion, everyone's running for liquidity, and they start pounding out their liquid names. There's going to be that dislocation. Whereas if I own a toll road or a seaport or an airport or whatever it might be, I still own it. And it's much like the difference between private real estate and public real estate. At the end of the day, we own physical title to irreplaceable, assets that are key and crucial to, global trade. And so I think I'm not just paying a function of a multiple of that. And so the, the way I'd frame it is kind of like one's a toll road and, one is what's driving on it. Both are real or durable and cash generating. But in a market that's really fallen in love with paper, run on cheaper money, like having a meaningful slice of our return come from real assets and contractual income rather than just multiple expansion is exactly where I want to be leaning. So the core and private sleeve, they're not competing. One's liquid, one's illiquid. They're just sized appropriately. They do different parts of the job. Back to your rugby analogy.
I want to sort of talk about this in the context of the wider industry for just a little bit. I think you kind of mentioned it before. Basically, a lot of Canadian advisors and Canadian industry leaders have said, yeah, single digit returns from, a solid 60-40 or whatever fund, or maybe they're shifting away from the 60-40 because of, inflation related correlations. But something like that is enough, and advisors are going to earn their value by providing other things. The holistic financial planning term, right, that you see everywhere. So how does an approach like yours and what you do in your practice fit in with, both the industry's call for and the genuine need among clients for services like financial planning, estate planning, tax planning, and a lot of those other kind of what used to not be in the core of an advisor's work, but is becoming increasingly important?
I would kind of chirp back to it as like people are going to gravitate to what they can and can't do, and if you can't perform, you're going to have to do something to be relevant. And so if you're going to play like distract over here and look at the magic bean because I can't generate you any meaningful rate of return, and the industry's, chock full of underperformance. And so is product. I think a lot of us are looked to as, I said, like it's that old game of barrel of monkeys. Like people like me are supposed to just connect people, product to people and have a relationship, somewhere in between. And so, while the average advisor has shown a dismal track record of being able to perform, you focus on what you can do. So largely in general, like the Canadian investor has become nascently comfortable with fair to average, results. And so gravitates to who does more things from them and does more services. So I want to push back gently on the idea that you have to choose. So first off, the best service is performance. I don't lead with performance because listen, without a plan and without truly embedding, I never say, listen, I'm the number one performing balance manager. Like I'm rewarded for this, this. Like I have a CV that's impressive, but I will tell you where we align is you start with the client's needs, priorities, and build infrastructure in and around that. But I think the best service ends up being performance. You can have the warmest relationship in the world and the nice quarterly reviews and the best client dinners. But if the money isn't compounding, you failed at your actual job and the relationship doesn't pay for anyone's retirement. So here's where the two genuinely connect. Real service is honesty. It's telling a client but having the confidence and conviction to do your job. And I think that is really aligning, and I saw that transition from career into, I attract now more than pursue. I have a large business. I don't need more business. So I'm a lot more clear in what a client relationship means and what I'm willing to do for it. And so largely, when people have a full service advisor, allow it to be full service and allow that advisor to do their job. And I think so many times emotions get involved in it where, markets are challenging. I step on rakes all the time. I get bonked in the head all the time, but my clients trust me to get up off the mat and keep fighting. I think a lot of relationships fall apart for clients and fall apart between the advisor, where the advisor doesn't feel empowered anymore to make those calls and make those decisions and really do their job. So as much as I would like to tease the advisors and say, look how great I am, I actually generally feel, empathy for what we do go through. And I think it's, when things are going right, it's our job to do that. But when things go wrong, it's seemingly our fault. Things go wrong all the time, but you have to allow people, to get back up. So, it's explaining why you own the boring hard asset instead of the hot name everyone's talking about at the dinner party. It's having the conviction to be a couple laps ahead and the candor to explain why, and then pull your ego out of the room and protect that. And that's not to separate from performance. It's how you deliver it over a full cycle. And so again, we don't pick, we obsess over performance, because that's the promise. But the promise is to earn our fair share of market returns. If you're going to be taking on systemic risk, and that is the things we can't control, you better be compensated for those returns. So, I really obsess over honesty because it's how clients actually stay invested long enough to get the performance. So service in the absence of returns is hospitality. And we're here to manage capital and manage outcomes for our clients.
Chad, I think that's an excellent note to end on, putting all this performance conversation into the context of client service in the industry. So all I can really say is thank you so much for taking the time and for sharing your insights with me and with our audience today.
A pleasure. Thanks, David.
And thank you to all of our viewers. For WPTV, I've been David Katai. Have a great rest of your day.